Hello and welcome. This is Jason Odell, Principal and Managing Partner at OJM Group, a national financial planning and consulting firm located and headquartered in Cincinnati, Ohio, as well as offices in Phoenix, Arizona, New York City, Long Island, and Fort Lauderdale, Florida. I appreciate you taking the time to listen to our podcast. This podcast will speak directly to life insurance as a retirement plan, how to utilize this tool and this concept in an overall retirement planning manner, the pros and cons of utilizing this type of a tool. And the goal of this podcast is to get you the general information in a quick, concise manner, and with a goal to get you to reach out to OJM so that we can discuss your particular situation in greater detail and determine if and how this tool might make sense for you. So a lot of the in-depth detail and analysis we're not going to cover. We're trying to give an overview here in a short amount of time and be respectful of your time. What you'll see is a page that has come up that is our disclaimer page. What is important about this disclaimer page is that you're working, when you decide to work with an advisor, you want to make sure you're working with an advisor that is licensed properly and is doing business in an environment that is regulated and controlled, as that is there to protect the consumer. Let's talk about OJM and the areas that we consult in. OJM, as I mentioned, is a national financial planning and consulting firm. We have a unique firm that we have built over the years. We have attorneys and CPAs. We have certified financial planners, investment experts, insurance experts that are all part of our team, and we work in a number of different areas with clients. So we have areas that range from asset protection to investment planning, and we have individuals that have expertise in those particular areas. Today we're going to focus in on the tax reduction silo as well as the insurance silo when we discuss cash value life insurance as a retirement plan. So you might be asking yourself, hey, why would I use life insurance? Well, life insurance as a financial planning tool has many uses. It can be funding can be done personally through a business or through a trust. There's asset protection features of life insurance in a lot of states where the actual buildup or cash value buildup, which we'll speak to in a minute, has protection by state statutes. So it can be a great tool from an asset protection perspective. It has tax benefits on the buildup of the cash value. So as the cash value is building up, there's no tax on that buildup, as well as upon distribution. If you decided to take some of the cash value out, if properly structured, there's no tax on those distributions. The death benefit can be received tax-free as well to the beneficiary, again, if properly structured. And there are many different options on how the cash value inside a life insurance contract can grow. So those funds growing on a tax-deferred basis and access tax-free can be used for cash flow purposes, for retirement planning, for buy-sell agreements. You can have the the death benefit used to protect or pay for estate taxes, business succession planning, and income replacement. So there are significant benefits of life insurance as a financial tool that clients can utilize it. Let's get into why life insurance as an accumulation tool may make sense. You'll see a slide here that's a slide that progresses from left to right, which what it is showing is how an individual would determine how much death benefit they would need and how much money they would be able to save on an annual, monthly, quarterly basis, and then what type of cash value life insurance policy you would be able to pay, what and how those policy values grow and accumulate, and how you can take those out through withdrawals and loans in the future, how at retirement that money can provide an income stream to you, but then most importantly at a death, or either a premature death or a death at life expectancy, how the loan or withdrawal amounts are going to be paid off with the death benefit proceeds, and the remaining amount is passed on to a beneficiary. This is a slide that shows the progression of a life insurance policy and how it works. Let's talk about the different buckets that are out there that each individual should consider in an overall diversified portfolio that is used for retirement. One, you have qualified retirement plan bucket, which those dollars that are contributed are deductible when they go in. They grow on a tax-deferred basis, and when you pull money out, which at earliest is age 59 and a half without a penalty, their money is all taxed at ordinary income tax. You have non-qualified accounts. So those are accounts where you're putting money after tax into an account, whether it's a brokerage account, a checking account, a CD, a savings account, where the money, you're paying tax on the money that is going into that account, and it's growing. If there are realized gains, you're paying tax at either short-term capital gains rates, long-term capital gains rates, or if a dividend is distributed out at dividend rates. And typically the distributions, when you sell that particular investment, will have taxation as well, whether it's at ordinary income or capital gains. LIRP, or a life insurance as a retirement plan, that's using life insurance. Dollars that go in are generally not deductible, but grow in a tax-deferred manner and come out, if upon distribution, in a non-taxable way. And we'll get into how this works. What's important to understand about this slide is that a combination of all of these buckets is important to have in an overall financial plan. The concept that a qualified plan is a place where money is going to go because you get a today deduction is the only or best way to save for retirement is not an accurate statement, because what we do know is that tax rates today are at a relatively low period in time, as you can see from this slide. You can see that based on the history of our tax rates going back to 1913, we're relatively low. The federal government actually is considering, and the new budget proposal from Obama came out recently, showing that they're considering or would like to tax retirement accounts on individuals that are making a certain income or that have balances of a certain amount. So the idea of putting money into a qualified plan and getting a today deduction only to pay a lower rate when you pull it out is typically not a concept that works for the majority of our clients. And therefore, maybe that's not the best bucket to save in. By no means does it mean you shouldn't save in that bucket, but maybe we look at the other buckets, the non-qualified bucket and the life insurance as a retirement plan bucket, as other mechanisms or ways to save for retirement. Where are taxes going in the future? No one knows, except based on the deficits that our country has today. We believe that tax rates can only go up, and if you look back at the history, we see tax rates increasing. Where are capital gains rates going? This is another concern. There's a study done by the mutual fund tracker Lipper. It showed from 1997 to 2007 that between 16 and 44% of the typical equity fund investor gains were lost to taxes, so that they didn't even consider or were concerned about the tax ramifications of making an investment into a mutual fund. That's shocking that you're giving up a significant portion of gain because of taxes. Managing money in a tax-efficient manner is extremely important. Again, looking at this chart, it's scary to see that we're at a low rate for capital gains, and likelihood of capital gains rates going up is high. Tax diversification, as we've already discussed and preached. Here's our buckets again. We've got money on the left bucket, which is in a qualified retirement plan. Examples of that are 401k plans and pension plans, traditional IRAs, and those dollars are going to be taxed at income tax rates upon distribution. So if we have an example of someone that's in a 39.6 federal tax rate, a 6.6 state tax, and the 3.8% Affordable Care Act tax, you get about a 50% tax. So on every withdrawal you're taking out in the future of your qualified plan, you're giving 50 cents of it to the government or to taxes. Therefore, a $100,000 withdrawal nets you $50,000 of spendable monies. If you have dollars in the middle bucket, which is outside of a qualified plan, whether it's in real estate or stocks funds, you're going to pay taxes at capital gains rates typically. Those are how they're generally taxed. Therefore, today at the 20% federal and the 6.6 state tax, that's the tax that most people forget about on their capital gains. You do pay state if you're in a state tax. And the 3.8 Affordable Care Act tax, you have a 30.4% tax. So if you take $100,000 out of that account and you pay the taxes, you're left with $69,600. If you put money into some of the asset classes that we believe are overlooked more often, like a municipal bond, a Roth IRA, or a life insurance as a retirement plan, generally those dollars are going to grow tax-free and come out tax-free. Therefore, a $100,000 withdrawal means $100,000 of spendable monies. So let's dig deeper into life insurance and talk about how a life insurance policy is structured and works. You have two types of life insurance. You have term insurance and permanent insurance. Term insurance is used typically for death benefit at a very inexpensive cost. I equate it to your auto insurance. It's a use it or lose it insurance. You pay a premium. There's a death benefit for your beneficiaries. If you die prematurely, then a beneficiary receives a lump sum check from an insurance company. If nothing happens to you, your premium is gone. The insurance company does not refund your premium back to you. Permanent insurance builds up cash value in it. It has a death benefit that pays a beneficiary at a premature death, but it also builds up cash inside of it. How it builds up cash is what makes life insurance different from each other. So we're going to cover a couple of these and how they look, which is one, you have whole life insurance. Whole life insurance builds cash because an insurance company returns a dividend to the shareholder, or the policyholder, I should say, and that policy grows. You have no control over the dividend or what the insurance company is going to return as a dividend. And typically, you've got no flexibility in how much you're going to pay in premium. Once you set out in a schedule, that's the premium you need to follow. You have no idea what dividend rate you're going to achieve because dividends are not guaranteed. But consider this somewhere of a return of a highly rated corporate bond. And money inside a permanent policy, as mentioned, is going to grow on a tax-deferred basis. When you take the money out, you can pull the money out on a tax-free basis if you do it properly through withdrawals and loans. You have the second type, which is universal life insurance. Universal life insurance, the insurance company takes your premium. They return an interest rate or a crediting interest rate back to the cash value in the policy. Again, something you don't have control over. Typically, the returns are going to be similar to whole life insurance policies, and you're going to have a little bit more flexibility in this policy in terms of how you pay premiums and flexibility of when you make those premiums, whereas whole life you have less flexibility. There's indexed universal life insurance. This has become a very popular product out there, and we're going to dig deeper into this because this is a product that we believe gives you some options. Indexed universal life insurance allows the insured to have a death benefit, pay a premium, and that premium is going to grow. And how it's going to grow is the insured is going to, or the policy owner is going to elect from a different set of buckets of money that are tied to indexes. They can select from those various indexes with some caveats. So if it's the S&P 500 index that they want to mirror, they would get the return of the S&P 500 with a caveat of if the S&P drops below 0, your account value would get credited 0. If the S&P 500 goes up above a certain amount, whether that's 10, 11, or 12%, you would be capped at that. So you have a floor on the bottom side, but a cap on the upside. But you get to allocate it into whatever the various insurance companies offer in terms of index buckets, and you get to participate on the upside of those, but you don't, to an extent, but you don't participate on the downside of that index. So this has become a more popular type of a product because you've got lots of flexibility and when you can make premiums, plus you get the ability to have different types of indexes that you can mirror and get that exposure to returns that aren't controlled directly by the insurance company. The other options, variable life insurance has sub-accounts associated with it. So in those sub-accounts, those are mutual funds, and you as the policyholder or policy owner or insured select from a list of mutual funds. Think of it like a 401k plan where you pick from a number of different mutual funds. However those underlying investments perform, up or down, is how your account value, your cash value in your insurance contract is determined. So in 2008, as an example, when the markets, in the general markets, the global markets were really down significantly, your investment in a variable life insurance contract would have been down significantly, so you participate on the downside. So you've got the flexibility of selecting investments, but you also accept the risk associated with those investments. The other type is a private placement life insurance contract. Private placement allows for someone to put in a life insurance wrapper around an investment account, and those investment accounts are managed in a manner that independent investment managers can elect whether they use private equity funds or hedge funds. They can use lots of different types, but the issue is that there are specific requirements with this. You must meet a certain threshold or requirement of premiums into these types of contracts, sometimes $5 million of assets or $1 million of premium going in. So it's typically not a tool that's utilized on a as often basis as the other 4 options. So let's look at a risk spectrum here that you'll see, which gives you an idea of left to right, going more conservatively to more aggressive. Over on the left, you'll see that your traditional CDs and savings accounts that have FDIC insurance are over on the left, more safe, secure types of investments. You get into some permanent life insurance like traditional whole life, universal life. Their guarantees come from the insurance companies that are behind them. You've got index universal life in the middle there. As you move over to the right, you can see you've got variable life insurance where you're getting more upside potential but more downside risk as well, and then the individual stock. So you look at this risk spectrum, you've got the left being conservative and the right being more aggressive. When we talk about why index universal life, as I want to get into in more specifics with you, I just wanted to show some examples here. You get the ability to have returns, market-like returns to an extent. You're not participating in all the upside of it, but most companies offer a number of different options. So they'll give you a fixed bucket where you can participate in the fixed account that the insurance company has. You can use their 1-year indexing bucket. You can use their 2-year indexing bucket. That just means for 1 year, from 12-month period of time, you're participating in whatever that index does for that 12 months. 2 years, you're participating in whatever it does for that 2-year period. 5-year means you're participating in whatever that index does for a 5-year period of time. Universal life insurance products, the good thing about it is that they're going to offer they will offer transparency in how it's designed, how the charge structure is set up, so that you can maximize the growth. You've got considerable flexibility in contributions. You can add additional riders to the policy that allow for the premiums to be paid by the insurance company if someone is disabled. There's long-term care benefit riders that can be used, or critical care illness riders that can be added onto these types of products, which has made these products even more beneficial than they have in the past. These are not your father's or grandfather's life insurance products anymore. These are products that are more sophisticated and have been designed and built to work in today's economic environment. Again, back to indexing and how an indexing return can be. If you just think of indexing as a concept and how this works, if you had a investment that earned 10% in year 1 and lost 10% in year 2, and you did that over this 11-year period of time, you would think over 5 up years and 5 down years, 5 up 10, 5 down year, average return would be 0. But you can see here your actual rate of return is negative 4%. What if we could just eliminate those down years? So we take away all the negative down years and we participate in just the up years. That's indexed universal life. Look what this does to the return. You take away all those negative 10, you participate in just the 5 up years, your actual return is 61. Your average is still 0, right? 5 up 10, 5 down 10, but you had a 0 return in the down years. You get a 61% return over this same period of time. Another illustration of this is look at what has occurred since 2000. If you have the S&P 500 and you made it a $1,000 investment and you put it into the S&P 500 with dividends, your account would have been $1,804 at the end of 2013. Without dividend, you would have had $1,399. If you used a floor of 0 and a cap of 12, that account would have $2,294 in it. It's a pretty powerful slide to look at. Now, how do you fund cash value life insurance? There's a number of different ways to fund cash value life insurance. Number one, you can fund it with after-tax dollars. It's very simple to put in place. You take after-tax dollars, you fund it into a life insurance contract. It, as I've mentioned, grows tax-free, comes out tax-free via loans and withdrawals and loans. Doing and properly structuring that is very important. There are other tools out there. You can use Section 79 benefit plan. This gives some tax benefit if you utilize this tool. There are restrictions and requirements on this, and there's less flexibility on this tool as well. You also can use Section 162 bonus plans. This is how an employer can make contributions on behalf of employees. They can have vesting schedule. It's a good way to recognize key employees when doing this. You can use it as a non-qualified deferred compensation plan. This is another way that allows you to put money away using salary deferral. It is the employer's deferring the tax deduction to a future date. Again, a great way to recognize key employees as well. Split dollar is another tool for funding life insurance, a way that you can make a loan from an entity or a corporation to someone or to a trust. That trust can then fund a life insurance policy that's repaid back the loan at a point in time in the future. It's a great way for businesses to minimize tax impacts on the business. Premium financing, this is where you utilize borrowed money to make the fund contributions. Certainly become a more popular tool of recent. However, this is a tool that needs to have a clear understanding. And so this tool, because interest rates are low now, makes some sense for clients, but it makes sense for clients that can afford to pay the premium. There's no such thing as a free lunch, and therefore those that would be telling you to utilize premium financing because it's free insurance is just not an accurate statement. So let's just go through one last example here on a 45-year-old, and we'll wrap this up. Number one, a 45-year-old that was going to contribute $50,000 a year for 10 years, and then they wanted to take distributions from age 65 for a 20-year period of time. Our assumptions are this individual is in a 39.6% federal tax rate with 5% state, the Affordable Care Act of 3.8%. We're going to show a comparison on the right side of if you put that money into a qualified retirement plan, how much could you take out? If you put it into a non-qualified plan, how much you could take out? And if you put it into a life insurance, cash value life insurance plan, how much you could take out? We're going to assume a 6.5% rate of return for all of them, and we're going to assume a 1% management fee. And you can see on the right, a qualified plan based on these set of assumptions could distribute out $47,945 a year for that 20-year period of time. The non-qualified investment, stocks, equity types investments would give you $54,943, where the life insurance would distribute out $78,339, or $1.5 million versus $1.1 million. There's a over $400,000 improvement utilizing the life insurance. There's almost $600,000 improvement from a qualified retirement plan. So you can see just based on the economics that life insurance as a retirement plan and as part of an overall portfolio economically makes sense for your individuals. What are next steps? We just covered the surface of cash value life insurance and how you can use this tool as an asset class. What we would encourage everyone to do is certainly reach out to us here at OJM. We would be happy to do an initial consultation with you. No obligation, no cost. Talk about your particular situation, how we can help you, how our firm as a diversified financial planning and consulting firm can work with you and be a resource to you. We can talk about this particular tool in your overall plan, what funding options make sense, how you build up cash value, what initial funding amount. We can review existing policies for you, give you our analysis on your existing policy. We'd be happy to do that. You can reach OJM Group in a number of different ways. Our website typically is the easiest way to do that at www.ojmgroup.com. Our phone numbers are also here up on the screen. I'd like to thank you for your time today. I appreciate it. We certainly would welcome the opportunity to speak with you directly.